All right, good day everyone. Welcome back to another episode of Spark Your Fire, or I should say, the first episode of Spark Your Fire in 2025. Live recording with John Camino. How are you, mate? Good to have you
Uh,
back.
Thank you. Yeah, nice to be back and back into the swing of things. Very energized for 2025. I'm looking forward to it. So good to see you again, and looking forward to the podcast.
You got your proper shirt on today.
Yes.
Must be some sort of occasion that's going on.
Yeah, I'm wearing boxer shorts though, so it's just from the waist up. So
When a salesperson's got their shirt on, we know what's happening.
that's right.
Had
That's
a good
right.
break?
That's right.
What was you? Did you go up too much, or what?
Didn't go anywhere. Just hung around Sydney and but chilled out. Went to the beach a lot and enjoyed it.
Busy
How about
doing
yourself?
deals, from what I heard.
Yeah, the market was back by like the second week of January. So
Oh
yes,
wow.
I've been straight into it. Yeah, yeah.
Sydney's still got a lot of demand, eh?
Mm.
Good.
I mean, enough. It's got enough demand and not enough supply for whatever it is I'm looking for. So
That's
it's
always the case. That's
yeah,
always the case,
always
though.
the
But,
case.
yeah. No, good. Good to have you back and smiling as well. I think, we're both looking forward to what's going to uncover for 2025. That's for sure. But look, let's kick off 2025 with our way overdue gold charts that your specialty, John. So yeah,
Yes.
so I think we'll lead in for with that today as our main topic of discussion because I'm sure that a lot of people, it's January, everyone's setting goals, everyone's thinking about
Yes.
if you're buying properties, where should I be looking at, what I should be thinking. So I think these gold talks, gold versus Sydney prices is going to be a great indicator for those people who's considering getting into property market this year, whether investing in the States or in Sydney, regardless. Okay, so all right, John, would you like to share your screen and then let's
Yeah,
go through it?
let's do it. If you'll indulge me though, before we get to the gold stuff, which
Absolutely.
is
Yeah.
which is my favorite, I want to just quickly go through two other things. So I want to. Can you see my screen by the way, David?
Yes, I can
All
now.
right. I want to quickly talk about the stock market versus the property market.
Mhm.
And if in doubt, zoom out. I always like to sort of go back to the biggest data set I can find and look at how the two asset classes performed,
Yes.
because there's always that rivalry between the real estate people and the stock market people. So let's put to doubt who outperforms who.
Okay.
So, all right, and I want to send a thank you to ChatGPT for this help. So if we look at the ASX 200, the top 200 stocks minus dividends and real estate minus rents over the last 44 years, so since 1980, the ASX 200, the stock market, does outperform the real estate market by about a percentage a year, but that's meaningful enough. And so, the stock market, does do a bit better. It's sort of narrowed a little bit over the last couple of years, but generally speaking, stocks outperform real estate. Now, if we look at the blue line, which is property, it goes from 1980 to 1990, and it's almost doubled in that time.
Yep.
Whereas the stock market's, I want to say tripled actually. It's gone up about 300% to 1990. So yeah, the stock market's tripled and the real estate market hasn't even doubled. Then by the year 2000, from 19, so over 20 years, yes, real estate's tripled, but the stock market's done nearly double that. And that's narrowed, but and they track each other and so on. But property's done about 6.5%. Actually, I think it's a bit under that. ASX 200 has done about 8%. So ASX 200 is going to outperform real estate, generally speaking. Any questions on this one?
No, I mean it's yeah, it's I think for those people who is able to see the screen, then it's quite clear. But yeah, for those people who's listening, I would highly recommend to jump on the actual video recording of this so you can actually see the graph. It's quite clear that for the 44 years of data that's been recording, ASX 200 has been outperforming by a bit in comparison to property. So the next question, John, is what makes we should all be looking at ASX 200 then, right? To maximize
We,
our dollar. Why are we talking about property then? I should just go away and buy ASX 200.
That's a very good question. So not quite, not quite. So in reality, the difference between the real estate market and the stock market is leverage. So
Okay.
people borrow to buy real estate, and in the ASX 200, there is some leverage, but there's not as much. So what does it look like with leverage? And this is going to be a little bit controversial, a little bit provocative, and but let's do it anyway. So this is the same chart and the same returns, but this time assuming that the real estate investor is at 80% LVR, so
Yep.
that they're borrowed 80%, which means they've put 20% down. And you can see that in the 1980 mark, they haven't started at the same point. At the same point, the real estate person has put 20% down, but is getting a higher value asset, whereas in the previous slide they start at the same point.
Yes.
So now we're borrowed and we've got a bigger asset base. In this, again, this excludes dividends, excludes rents, but now instead of 6.5%, you're getting 29% per annum. You're getting 29% per annum on your upfront deposit, essentially. This is why real estate creates wealthy people.
Mm.
It's because of the leverage and the asset inflation that you get. And so you are getting 29%, even though the headline is going to say that real estate went up by 6.5% this year, let's say. You as a real estate investor with your leverage are making 29% in terms of capital gains. Now, before anyone throws a mug at the laptop or throws their iPhone onto the ground in horror, I totally acknowledge that this is not a completely fair comparison. And the reason it isn't is because what the real estate investor makes in capital gains by magnifying the capital gains with leverage, they are losing in cash flow. So and this chart does not reflect the servicing of interest repayments,
Yep.
nor does it reflect the tax deductibility of interest repayments and all those sorts of things. It's also a little bit unfair to the stock market because you can get some leverage, and people often get margin loans, and they wouldn't be 80%, but it would be something. And so, um, but I think it broadly reflects most people's experience with real estate. So, uh, almost people who invest in real estate always borrow, and people who invest in stocks sometimes borrow, but most people don't. Most people just buy based on their savings account. So this is, I actually think, while it's a little bit of an asymmetric comparison, a little bit unfair, I think it's actually most people's experience.
Mm.
And so, yes, now we're comparing an 8% return in the stock market to a 29% return in the real estate market. And real estate goes from being a pretty boring asset, to be honest, a pretty boring asset, to an exciting and a slightly risky asset. Thoughts on this one, David?
Well, it's mostly because of the leverage that we can
Yeah.
go that goes again with the property investment side of things,
Hmm.
right? So, but I think a better version of the chart, like you rightly pointed out just then, the 29% per annum growth doesn't take into account of the cost
Yes.
that's being right. So as you mentioned, the interest repayments, the tax deductibility, etc. I mean, forget about tax. That's obviously cream on top, and at the it can be the negative gearing can be scrapped at any time. To be honest, so. But maybe a more fairer representation potentially for next time is, we make some assumptions around the cost that's associated with
Mm,
holding the debt for that period of time, on an average of, I don't know, 6 to 7% interest rate.
yeah.
So every year, you take that gross return of 29%, subtract the cost or the average high level of cost that you hold onto the debt, and that number is going to come down, which might give us a bit more fairer comparison, right? Ultimately, we can't just say, hey, 29% growth and full stop. Right now we have to put caveats because, hey, this is not apple by apple comparison without including debt. But
Yeah.
it's a great start, I reckon, John. It's a
Mm,
great start. I think it illustrates the point, that's for sure.
yeah.
It shows how much and the reason why people are looking at investing in property with leverage. Because yeah, you just get so much compound growth in the long run with it.
Yeah.
So yeah, definitely a fair start. But yeah, that would be my comments around,
Mm,
how can we do it better next time and a
yeah.
more fairer comparison for ASX 200 as well.
Look, I agree. I agree.
Mm.
And one other sort of final kind of thought from myself would be that we're actually comparing very different asset classes. I mean, we compare them only because they're asset classes, and only because people consider them, when they're talking about their wealth. But the ASX 200 is a very liquid asset class, so you could sell it. You could sell it immediately and have the cash within an hour. And so the ASX 200 is more like a savings account these days, particularly with the rise of index funds. The the real estate market is highly illiquid. It's a very tangible asset
Yes.
class, and it's only liquid to the extent that you can renegotiate your loans. So very different asset classes, and maybe they're silly to compare in the first place, but this is why real estate generates millionaires. Um, so it's quite a useful tool.
Mm,
But yeah, there is scope for improvement here.
great
All
insight.
right, let's have a quick look. So let's get to sort of the nuts and bolts of what we like to talk about here, which is property versus gold. And
Yep.
um, I mean, I'll get to gold, why we're even talking about gold in the first place. But this is Sydney house prices. We do this about twice a year. So I remember last time we did this, which I think was mid 2024. I could be. It
Yeah,
was
about that.
around here, yeah. And so we weren't at all time highs, or we're about at the all time highs. But real estate, and this is Sydney house prices, not dwelling prices. It doesn't include units. But Sydney house prices are up near all time highs. The rate of returns are quite low at the moment. So the percentage gains have actually been quite low. But I always point out the same thing when I look at this slide, and that is that since 2008, real estate gave very steady, boring returns, around the 6% mark per year. But then from 2008, it became very volatile, and this is when a lot of noise around real estate started emerging. And the reason is because we see a series of V-shaped recoveries, a series of shallow crashes and sharp recoveries.
Mm,
This is, I think that this is economically explained by the fact that we've had very loose monetary policy this century, since 2000, really. And there's been no problem, social or economic, that low interest rates hasn't been parachuted in to solve. So this is what a highly activist central bank creates. This is kind of not normal. But either way, but the returns are still about 6.5%. We just have these crashes in the meantime, but when you average out the returns, they're still the same. So Sydney real estate, to some degree, is doing what it always does. I think that one of the key messages of this chart is actually hold on, because the recovery is coming. So if the real estate market's in the toilet, as happens, and was unusual until 2008,
yeah.
the recovery is around the corner. So don't sweat it. All right. Real estate versus gold, however. So why do we look at gold? So gold is an international asset that represents money. The reason the central banks hold gold in their vaults and they don't hold diamonds is not because gold is more valuable or diamonds are less valuable. It's because gold is a monetary asset. So gold is international money. So, and gold isn't changing too. It's an ounce of gold is an ounce of gold 5,000 years ago, and an ounce of gold is an ounce of gold in 1940 and 2024, and so on. So it's a constant store of value, and it represents money in a way that oil doesn't represent money. It's more of a commodity. So, and the other thing is gold is stored and not consumed. Blah blah blah. It has the attributes of money. That's why we're looking at real estate versus gold. Um, the reason this is important is that while it feels like real estate's going up all the time, really it's just inflation. It's just that there's more M2 in the system, there's more currency in the system, the price of everything's going up, including real estate, but not only real estate. Bread prices are going up, rents are going up, egg prices are going up, everything's going up. And actually, if we were just to strip out, which is just currency mischief, um, that's the best way to know if real estate's going up. Now, what's been the big kind of thing over the last 12 months? Well, the Aussie dollar's been crashing. So that means anything that is denominated in Australian dollars, real estate, but also yours and my wages, our salaries, they've
Mm,
been crashing along with the Australian dollar.
yes.
And so, how do you reflect that? Well, you reflect that by pricing things in gold, because gold is going to capture that currency manipulation. and that store of value. And what we've seen is, and just to sort of cut to the chase, real estate priced in real money, priced in actual money, not sort of government fiat, is quite low at the moment. In fact, it's the lowest it's been since 1994. So we're down at 360 ounces, and traditionally it bounces off these levels. You see, I'm not sure if you can see my cursor, but this is 2020. This is the COVID crash. Over here is 2008, and
Yes,
actually
I
we're
see.
below those levels now. So
Mm.
something is shifting in terms of the wealth, and the last time we were here was the early 90s. Now, why did it have this permanent shift up here? Well, this is deregulation of the banking system. It means you can get a loan, whereas previously, it was quite a conservative banking system. Now, where does it go from here? I don't know. I mean, I don't know the answer to that, but I think that we're at a very precarious point. If we break lower, like if this chart, if the real estate market goes down and if the gold price continues to go up, there's really nothing from a chart perspective, to stop us going to 200 ounces, in which case it would be generationally cheap. Like it
Mm.
would be the cheapest in, say, 50 years.
Mm.
Um, hmm. Do we get there? I don't think so. I really still think that we get back up to these. I feel like, hmm, I feel like real estate is actually going to have a very strong end to the decade, or at least run through the mid decade. And I think that real estate moves higher, but I could be wrong. I could be wrong.
So the way to interpret this, John, just to make it easier for our viewers and listeners,
Mm.
right now it's sitting at about 360 ounces
Yep.
price in gold.
Hmm.
And the lower it is, it means Sydney property prices are actually cheaper in that case.
Yes.
And the closer
Yeah.
or the higher that it goes towards the 600 or even 700 ounces, that means Sydney price is actually more expensive when compared with gold.
Hmm.
Is that because that's the
Yeah.
ratio, right? That's what you're looking at,
Correct. Yeah.
right? So okay, so so towards the bottom means Sydney's cheaper. If the line starts shooting up, that means Sydney house prices or real Sydney house prices are actually going up. So at the
Yeah.
moment, you're alluding that it was pretty much on the same level as 1994, putting
Yes.
fiat currency aside. Basically, it's
Hmm.
on the equivalent level as 1994, which is relatively
Hmm.
cheap at that point. So, um, so, so the conclusion there is, even though from a monetary aspect of things, Sydney house prices looks like astronomical numbers, but in real terms and in real dollar terms, it's actually relatively cheap.
Yes. Yes. That's right.
Okay.
It's relatively cheap. Let me give you sort of two kind of explanations. Over the last 12 months, Sydney house prices have done very little. They're up about 3%. But what's the Australian dollar gone down by? 15%.
Yes.
So the Aussie dollar, which is what
Aussie
our
dollar.
assets are calculated in, have gone down. So unless real estate prices go up considerably, that they can't make up that decline in value. Whereas if you look at this run from the early 90s through to 2004, I think that's sort of broadly the
Yeah.
Howard years, we had increasing house prices and an increasing Australian dollar. And add them together, that's the total value in like a international currency of what Australian house prices are. So this was the real bubble. We're nowhere near bubble territory. If you remember, after 2004, it took about 13 years to before the city property market started growing again. Um,
I think it was relatively flat for a long time.
yeah, flat for a long time. Flat for a long time. So we're not seeing that. Now that doesn't mean it can't go lower, but it means it's not overvalued.
Mm, mm.
Yeah,
Interesting. Yeah, yeah.
there we
No,
go.
it's good. Always good to
There's,
hear.
there's an English YouTuber who actually does this as well. So I'm not Robinson Crusoe and the gold to real estate ratio. And he goes, look at this, 200 years. And uh, he goes, English house prices are what they always have been. And it's, like it's quite an interesting that there are some people who perceive value in the same way, and it's very reliable. It's a very
Yeah.
good
Okay.
judgment.
Yeah. 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 Right. Okay.
Yeah.
They're comparing English prices, English house
Yeah.
prices, as opposed to Australian house prices.
Yeah. Because you can't really ignore currency. If you own a house in Zimbabwe and you think your house is going up by 5% per month, and you go, I'm a bit of a genius, but your currency's crashing by 50% a month.
Mm,
It's like, no, you're not getting richer, you're getting poorer. And I think this is a great way to see through it.
mm.
So all Australians have become a little bit poorer this year because of our
Yeah,
dollars.
indeed.
Yeah,
Yeah. Okay.
all right. Now, I think one of our other kind of more popular segments is like, well, how's my capital city doing in Australia? And what we do is we're going to go through the grounds, we're going to go through all the capital cities, but we are going to use Sydney as an anchor, and it's kind of elevates Sydney to a level that it probably doesn't deserve, but it's the main capital. So we're going to say, how are the capitals performing compared to Sydney?
Yes.
Um, and we're going to look at the cities that are a bit expensive, and we're going to go through the cities that are cheap at the end. But yeah, so we're going to start with kind of the overvalued cities. Now, just because a city is overvalued doesn't mean it's not going to keep going up. I think we're going to that there's like raw valuation and then there's momentum, and but we'll come to that. So let's. Anything to say before we get going on that, David, or happy to
I
go into
think
the
it's
first one?
good. Property investors a good indicator in terms of which city they should be probably eyeing at the moment. Which city
Yeah, yeah.
presents more value over others? I guess
Mm,
is more because we're as property investors we're always looking for value. So this will be a great way to measure value using Sydney as an anchor city and compare that with the rest of the capitals to see. So and you'll be surprised. I think, John, you
yes.
you were surprised when you compare this because you thought that certain cities have pretty much ran out of steam, but the chart didn't suggest so.
Mm,
So,
correct. 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 Yeah, we'll come to those. I think that's a good call out. The first city that is overvalued is Brisbane. But as you say, it's not as overvalued as you might think. So here we have, so all of these are going to be the Sydney ratio, or the Sydney to Brisbane ratio, the Sydney to Melbourne ratio, and so on.
yeah,
And anytime you see the line going up, Sydney's becoming more expensive, and anytime you see the line going down, the other capital city is becoming more expensive. And so this dotted line in the middle is what we call a line of best fit. It's really just which city has performed better over the 40-year periods. This is from 1979, so 45 years. And here we can see over the 45-year period, Sydney has outperformed Brisbane because the line is going slightly up.
mm,
But we can see that it is also closer to the bottom than it is the top. So Brisbane is slightly overvalued, and suggesting that Sydney probably will outperform Brisbane this year, but it kind of but then there's the next step, which is which way is the momentum going? And this chart is a bit hard to read in terms of momentum because
true.
up until very recently the momentum was with Brisbane, but there seems to be a little bit of a bottoming here. Does it turn around and go back in
Yeah,
Sydney's favour?
yeah.
Hard to tell. But look at 150%, which is to say that Sydney is 150% of the price of a house in Brisbane. That is typically a little bit below where it normally is. It's normally around 170%, around this mark here, where the dotted line is. It's just kind of average. So this is in the Brisbane expensive category, but
Yeah,
not by as much as you might think.
yeah.
As a Brisbane property owner, David, what are your thoughts when you see this one?
Yeah, look, I think I broadly agree. Brisbane has been doing fairly well rapidly over the period of time, at least in the starting from the 2020s when COVID started, right? It started shooting up like crazy around that point, and there's so much interstate migration that goes in, which is what's driving that price, and because there's so much demand now for dwelling there for people to live in. So, but yeah, like I said, it's difficult to read the trend. Like I
Mm,
say, you don't know whether it's going to continue to move towards Brisbane overvalued or whether it's going to go more towards Sydney overvalued. It could go either way at this
yeah.
stage. I think it just comes down to the how the economy performs over there as well. And to a degree, Brisbane is also has a small sector of mining that's related
Mm,
to that as well,
yeah.
which could also have an impact on that
Yeah.
either.
Plus the Olympics.
And the
Olympics
Olympics.
coming up, and it's hard to see sentiment move away from Brisbane for at least another couple of years. So I think it's solid investing for a little while. I don't know that much about Brisbane, to be honest, but it is slightly expensive. So and that'll happen from time to time.
The yield doesn't quite add up at the moment,
Right.
as we can kind of tell as well, right? So, if I correlate this when I got into Brisbane around 2015, 2016, it was definitely around Sydney overvalued sector,
Yeah.
and that's around the time when the yield was really, really good
Mm,
as well. All the way picked up to about 2017, and then yeah, started to come down 2018 because I think 2018, 2019 Sydney had a bit of a have a pullback, so
yeah.
automatically that's why Brisbane the graph has moved towards Brisbane overvalue a lot more during that
Yeah.
period. And yeah, it's
Yeah.
since then it's pretty much been slow and steady,
Yeah.
and yeah, pretty explosive in the last few years. So I reckon it'll be a slow and steady market to put your money in. That's for sure.
Yeah. 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 I think if I had to put money on it, Brisbane would probably have a better year than Sydney.
Safe
But
bet. It's a safe
yeah.
bet.
Yeah. All right. So Adelaide, we're talking about Adelaide a lot, and it was a bit of a sleepy city for quite a long time, but it's performing very, very well. This also comes under the Adelaide expensive or Adelaide overvalued category, and it's a bit more compelling, I think, than Brisbane, as it's a bit more obvious that it's overvalued, but it's been more overvalued than this before. In 2008, it was much more overvalued than it is now. So it's not kind of staggeringly problematic, but it is in the overvalued category, and this is quite convincing. Um, so,
That line
and
of
this,
investment now kind of showing more towards Adelaide means,
yeah,
that the you actually get more return on investment
yeah,
if you invest in Adelaide
yeah,
over the 40 odd years. I think from
yeah, that's
1993.
right. Since 1993. Yeah. So
Wow.
there you go. Yeah, I kind of feel like Sydney will outperform Adelaide, but with one caveat. I saw some vacancy rates the other day, and Adelaide has like some of the lowest vacancy rates in Australia, suggesting that maybe it's expensive, but they still have a shortage there. They're grappling with general shortages, and so well, I've always said that the vacancy rate, even though it's a rental measure, it is the best uh, and most current indication we have of just surpluses or shortages. And there's still a shortage of housing in Adelaide. So I don't know what the driver is, but it is on the expensive side at the moment.
Yeah, interesting. Yeah, and look, I think that's generally in line with our expectations as well. I think in 2024, Brisbane and Adelaide, and, well, Perth, like these are the three top performers from our last episode. I think Adelaide was number two from memory. Perth was number one. Adelaide was number two. So it's gone through a
Yeah.
very rigorous, explosive cycle of growth.
Mm,
Yeah, I think it's now putting it into an overvalued territory. And then yeah, I think it's looking at the trend. I think it's a bit difficult, but I reckon it's starting to swing around a little bit as well. So
yeah.
it's probably going to move more to a neutral stance in the next couple of years. Um, yeah, as it starts to recover a little bit as
Yeah.
well.
Yeah. Yeah. All right. Agreed. Sydney to Perth. Okay, this is. I mean, certainly one I was quite interested to see
Mm.
when I was pulling this stuff together. And this is just in the Perth overvalued category, but like just. I
Yep.
think what I've underestimated is how undervalued Perth was before it got going. It was extreme. It was an extreme undervaluation back in
One.
2022, and even though we're nearly 3 years into a big Perth bull market, it's probably not over yet. Like, it's done double digit growth, I think, for 2 or 3 years now,
Hmm.
and it's tempting to just superficially say no market can do that amount of growth for that long, but really it's still not that overvalued. Um, so with that said, David, what do you think? Because I know that you deal with clients buying over there, and it's getting a bit harder to sell.
Yeah, I mean, anecdotally, I think it's not selling as fast as or as quickly as how it was previously. I think that narrative started to turn last year,
Mm.
or towards late last year, I should say. Yeah, the last quarter of 2024. So yeah, it's an interesting market to watch. I got to say, I certainly feel that the buyers weren't as desperate and active
Mm.
potentially, and maybe that's just because the numbers don't stack up anymore. So investors are getting a lot more cautious when entering into the Perth market, especially after seeing a double-digit growth for about 2 years.
Yeah.
Anyone should be cautious, regardless.
Yes.
So yeah, so when some of my clients are looking to sell out and liquidate that profit, they're not getting much bites, and that might potentially be because it's January as well.
Mm,
Everyone's pretty much on holiday, so um, but it certainly wasn't like a bit of a mad rush type of position where you get 20 offers on the first open or even before first open,
yeah.
that kind of madness. So yeah. And I think that line, I mean, looking at that line as well, it's starting to soften. So
Yeah.
again, it'll be interesting. It'll be interesting to see whether from this point onwards, whether it's going to move more towards Sydney overvalued or it's going to be continue to swing more towards the Perth overvalued
Mm,
side of things. In other
yeah.
words, is how much more steam has Perth got to go at this stage? We'll find out. We'll have to
Yeah.
find out.
I mean, look, it can go a lot lower, but this seems to Perth is subject to drift. Like once the Perth mania is over, and maybe it's over, maybe it's got a bit more, then it just kind of drifts. And so Sydney then does its 5-6% per year, and Perth doesn't do anything. And it's successfully markets are clever. Like it's successfully um, solved the undervaluation problem that Perth had back in 2022. It's no longer undervalued. It's slightly overvalued, and we'll see. We'll see now what
Now more like
happens.
back in a balanced
Yeah,
state,
back into balance. Yeah,
right? It's in the balance at the
yeah,
moment. So yeah. But if you put money, if you bought a Perth property back in 1990 and you still hold it now, I mean you get slightly more return than
yeah.
Sydney.
That's right.
It's not
That's
like the
right.
best bid at the moment.
That's right.
So still not a bad outcome.
Mm, all right. Sydney to Hobart. I've got this in. I still think that this is mildly in the Hobart overvalued, but it probably is, but it's probably equally, you could say it's balanced. It's certainly in the middle of the range, maybe a bit more
Yeah.
towards Hobart, but it's blown off the Hobart overvaluation. I mean, I know that I think Propertyology called Hobart as very undervalued back in 2017.
Mm.
They were very correct on that, and so they rode that shortage in Hobart, and they got some great returns for their clients. And now that's unwinding now. Uh, so that was a great call, and I think that Hobart's still a bit overvalued, but it's kind of looking balanced. It probably underperformed Sydney for one more year, and then it'll be back into balance. But Hobart since 1996 has way overperformed Sydney, and I think it's giving some of that back at the moment.
Yes. Yes, very true. Small market, but yeah,
Small market.
I'm surprised to know that yeah, it's recovers so quickly. I was expecting a few more years of Hobart being
Yeah,
overvalued, but yeah, it
yeah.
looks like at the moment it's pretty much in balance, I gotta say. So, investors might be buying Hobart sooner or later,
Yeah.
potentially the next couple of years once they've done the rounds.
Yeah, it's not looking very exciting. I think if you're to buy in a Hobart, you'll get, your average kind of inflationary returns. You're not buying into extreme overvaluation or extreme undervaluation. It would be like most of the like, to be honest, most of the capitals look to be in balance besides a couple that are
Yeah.
standing out, which we'll go through.
Yeah.
Um, Canberra, this is we were discussing before we turned the video on that which one this is, and I think it's in balance. I think it's in complete balance.
I agree. I think it's pretty much and like this is another market that was surprised as well because Canberra has been quite overvalued, especially about 2 years ago. But yeah, in 2 years' time, look at that. From 2022, it was very towards Canberra overvalued, and
Yeah,
now in about 2024, back in about November or October period, it's now pretty much in the balance as well, in the middle.
yeah,
So yeah, I think it's yeah. And what's surprising as well, like a lot of these markets, apart from I think the first one, Brisbane has slightly better return over the years. Now it looks like pretty much all the other markets had much better returns than Sydney.
yeah. Yeah, that's true. That's
Compare that
true.
snapshot, right? So
Yeah,
yeah,
yeah, yeah. I mean, I wear, I'm very Sydney centric, and I kind of think that Sydney outperforms everything, but it's not true.
not true.
And but it also depends on what your starting point is, and this is why, like, I prefer some of the older the Sydney, Brisbane, Melbourne charts where you've got the chart going back to the 70s, whereas some of these go back to the 90s, and it's not
Yeah.
as
90's only about
telling.
35 years
Yeah, yeah.
out right here. So yeah, but Yeah,
I love
okay.
how we say the 30 years of data is not enough to like, I like that we zoom right out. So,
When you had a bit of a relative comparison, when you got some other capital cities that you can get 40 or even closer to 50 years, yes, ideally you will want that, right? So,
all right. All right. So the next two, and you can probably, through the process of elimination, figure out which are the two that are undervalued. So far we've talked about capitals that are either overvalued or imbalance, and there are two. The first one is Melbourne. So Melbourne is undervalued,
yep.
or Sydney is overvalued in comparison to Melbourne. But Melbourne's undervalued, but it also doesn't look like it doesn't look. It looks like the momentum is still against it because there's no kind of bottoming out formation or anything like that. It looks like it's going to go straight up to this 160%. Been a bloodbath in Melbourne. I know, his stories about developers and all that sort of stuff. I mean, they need prices to be going up to make any of this economically viable. And Melbourne's undervalued. So if you were a scavenger, let's say, or put more politely, if you were a value investor, Melbourne is one of the places to go.
Oh, great value at the
Yeah,
moment.
yeah,
Yeah, no, absolutely. From a long-term perspective, right? Like
yep.
this is kind of towards the 2003 level or 2000
Mm,
back at
yeah,
that
that's right.
time, right? Before Melbourne swings to be very, very overvalued around 2010. And then goes back up again and then becomes very overvalued again in 2017, 2018. And yeah, now it's swinging around again. So
Yep.
it's a W curve with the look at it, right? So you got the double there. But yeah, I think the biggest challenge, like you said, is the current regulations around property, land taxes. There's a lot of headwinds at the moment from people
Mm,
moving to Melbourne. And also with interest rate at current level, the numbers just don't work. And that's
yep.
why I think I suspect the curves, that line has still got a bit more to go towards the 160% mark, which means it's still undervalued. And yeah, might be for another 6 to 12 months, depending on how quickly the rates come down. I think once rates
Yeah.
come down, that line's going to start to turn. So
Yes. Yes. It'll. I think Sydney and Melbourne will turn earliest as well, as in
because they're
there's
sensitive.
because
They're,
they're
they're
sensitive to
most
interest
sensitive. They're
rates.
most sensitive to interest rate changes. Yeah.
Yeah, yeah. The other thing about Melbourne as well is, we're talking about a big, like if you believe in the capital city story, if you believe in capital cities are better than regional areas, this is, a massive city. And so it's safe investing in that perspective as well. So you're going in into a big metropolis, you're going in at multi-decade undervaluation, certainly getting there. This would look like not a no-brainer. There's no such thing, but it looks like fairly safe investing. But that said, as you quite rightly pointed out, there doesn't seem to be any change in the momentum right now, but things can change quickly.
But
All
since
right.
1979, so that line of best fit's still erring more towards Melbourne. So does that mean Melbourne's still getting more return than
Yeah,
Sydney?
Melbourne's outgrown Sydney.
Wow.
Yeah, yeah.
I think that basically kind of equates to our initial narrative to say Sydney is very cheap from a relative perspective.
Yes, this is right. This is no one wants to. It's hard to say, and no one wants to hear it. But Sydney's expensive, like compared to what? All right,
Mm.
all right. Yes. All right. Let's go to the next one, and the last one actually.
Yes.
Darwin. Now, Darwin. I mean, I don't know how many listeners we have in Darwin. Shout out if you're from Darwin, but Darwin is at an all-time undervaluation position. It is cheap there. I don't know if it's turning around as well. So we might go to extreme. I mean, we're already at extreme undervaluation, but it seems to be continuing in that direction. Darwin's been a terrible investment for a long time now.
Yes.
But if you're a value investor, this is where you'd want to be. I saw some charts. So I mentioned vacancy rates in Adelaide before. So if you look at that same data for vacancy rates in Darwin, so vacancy rates in Darwin are high, suggesting there's still an oversupply or not enough demand to meet the supply. So it's looking like that could continue
Mm.
into extreme undervaluation territory.
Wow.
But as we saw in Perth, I mean, this is kind of the Perth from 2 years ago. This is it.
Yes.
So if you these markets can correct quite quickly. So Darwin is the cheapest capital by far, followed by Melbourne.
at 250%. I mean, it's crossed that line now. So this is the last time it hit this level is 2003.
Yeah.
About 20 years ago. It's on the same affordability as about 20
Mm,
years ago. I think it's clearly, yeah, and it makes a whole world of sense because I think the yield there is, I look at that, it's like, oh, that's like that's like what we had back when I was buying in Logan in 2016.
right.
You got about 6% yield, 7% yield for houses, right? So that
Yeah.
shows your affordability there at the moment. But yeah, you're right. I think people should be cautious, especially the vacancy rate side of things. That's always a an indicator to consider right now. So yeah. But yeah, from a numbers and from an affordability perspective, and this chart definitely kind of tells the story that Darwin is a great
Yeah.
time to buy in.
Mm,
Yeah, if you're looking at getting value out of it, that's for sure.
yeah.
Although I'm not sure, John, would you be looking at holding it for long term? Would you be looking at more based on this chart, like just based on this information? If you're looking
Right.
to buy into Darwin, would you be looking at maybe getting in and getting out in a shorter time frame rather than looking at a 20-year horizon type
Uh,
hold?
you'd want to have your eye on the exit. I mean, it'll be a funky ride. I think that you'd want to hold it for between 5 and 10 years
Yeah. Okay.
because I think it will go back down here, but you need to give it some time to do that.
Yeah.
Also, I think it also reflects that some of these Sydney is quite risky a risk it's a much less risky capital city than all these other places, and so we it doesn't have the return potential that Darwin has, but there's probably not going to be a cyclone in Sydney either.
Yes.
So there's all these risks that can come along with having this incredible potential upside.
Yeah.
So you need to weigh up the risks and the benefits as well.
Yeah.
And
Every
Sydney's,
capital. Yeah. Has.
yeah,
Yeah.
sorry, but you're right. Every capital city has its risks and opportunities. So anyway, that's the last capital city. So I think to recap, I think we had all of the capital cities as mildly overvalued compared to Sydney,
Mm.
with the exception of a couple. Melbourne and Darwin are cheap, and then there was Canberra, which was in balance, and I think you could say Hobart was in balance as well, which means that the expensive cities are Brisbane, Adelaide, and Perth.
Sounds about right. And it's a great summary, John, as well. Thanks for taking time in terms of doing these up. I think it's always interesting to see how it's going to perform. But I reckon should you have this graph ready in December, would your predictions have changed? I wonder.
Well, yes, they would have. So let me. I mean, not that I don't have an opportunity to recast my choices, but I think I said Perth would be the weakest performer. I don't think it's ready for that yet. I don't know. I'd have to rethink it, but maybe Adelaide. Maybe Adelaide's the most expensive, but we'll find out at the end of the year. But
We'll find out at the end.
yeah, yeah,
Don't forget, there's always the element now, given there's so much M2 that's around the market, that's in the market at the moment, right? So much money printing, and also we've got a lot of buyers agents now as
yes,
well, like who's taking drones of their clients to different
mm,
areas. So, they could that potentially means if a buyer's agent is taking a couple hundred of clients to Darwin, a big buyer's agent, that's going to drive the market up
quickly.
was to a similar degree to what like they've done with Townsville and the northern part of
Mm,
Queensland, right? So that those could change fairly quickly, I think, and that kind of corresponds to your chart, which is the magnitude of those changes are fairly short duration as well,
yes.
just because it fluctuates a lot more, because there's so much money in the market at the moment. So
Mm,
you never know. Maybe Darwin will turn around fairly quickly, and it's gonna more move more into a balanced state in 6 to 12 months' time. And
yeah,
maybe Perth isn't gonna come back that quickly either. Maybe it's gonna stay stagnant for another 12 months
yeah,
instead. So who knows? It just comes down to where the money's gonna go to,
yeah,
and where
yeah,
the property investors is gonna go to. Yeah, but the main thing is I think the numbers need to make sense.
yeah.
Yeah, people are struggling with interest rates, unfortunately. And yeah, I know there's a lot of families that's wishing for cash rate drop as early as February.
Yeah. I think their wish will come true, actually.
Mm.
But I think one of the things that this showed, because I think overarching this was that Sydney itself is cheap by kind of
Yes,
long-term standards, and that is driven by a very weak Australian dollar, an unusually weak Australian dollar.
yes,
It's making everything here cheap.
yes,
So watch the RBA decisions are really going to matter over the next couple of months.
Yep.
And if the Aussie dollar keeps falling, it's going to be Sydney real estate, Australian real estate in general is going to be very attractive to foreign buyers.
Yes.
And that'll probably be where the initial pickup comes from.
There'll be a lot of foreign investment coming
Yeah.
in. Hmm.
So you'll see that at the top end of the market, that'll start to pick up, and that'll be the signal that we're back.
Yeah, gotcha. Okay, awesome. All right.
Yep.
Thanks, John. Anything else?
All good.
Oh,
Nothing.
thank you. Thanks for sharing, and thanks for another great session, sharing all these information with us. But yeah, look, thank you all listeners and audiences for joining us today. We will be back in the podcast again in about 2 weeks' time. Until then, we'll have stay safe and yeah, we'll chat to you guys soon. John and David.